sentimental rub-off, or is there going to be more than that? Well, right now I'm looking at the U.S. markets currently trading down. The Dow Jones is taking a cut of around 0.6%. So there is more than that sentimental rub-off. 35,400 levels is where we're at on the Dow. The Nasdaq is taking a cut of more than 1.5% as we speak. It's currently trading around the 14,000 levels. The S&P 500 is taking a cut of 1% as we speak. So 4,530 levels is where we're at. Those are the indices on Wall Street taking a knock after Asian markets. The Indian markets have all played out. The immediate knee-jerk reaction to the Fitch call on U.S. ratings. But let's further decode that. Anurag Singh, managing partner at Ansid Capital, joining us with Peter Cardillo, the chief market economist at Spartan Capital Securities. Gentlemen, great to have you with us. Anurag, these mounting debts at the federal level, state level, local levels, also citing of a fall in governance standards over the last 2 decades in the U.S. Those are the reasons that Fitch is offering as reasons for the downgrade. How severely do you think it's going to impact global markets? Do you think it's going to have a far-reaching impact? Should investors be worried?
Yeah, so Vikram, impact on the markets is one thing. Look, I think markets have anyways run ahead a little too quickly, I think, at least for our comfort, right? But, and so markets can anyways fall for various reasons. But eventually, I think, kudos to Fitch. They've given a right cautionary call to the government that, look, this constant heckling over the reserve currency can't continue in the last moment. The world can't watch the kind of the theatrics that goes on in Washington. But more importantly, Vikram, that, you know, this reserve currency status comes with a lot of responsibility. And I doubt over the past 20 years, the politics of Washington has shown that responsibility that they owe towards that. We can talk about numbers, but the kind of reckless spending that is going on, it might keep the economy going, it might keep employment going, but I think a reality check has to come someday. And the government will have to acknowledge that the welfare spending programs need to be cut. There is no other way out of it, Vikram.
The debt ceiling keeps rising all the time, and this is obviously at the end of the day, Peter, going to have an impact. As far as Fitch is concerned, they are calling it out. As far as confidence in the U.S. economy is concerned, how damaging do you think this is going to be? Peter?
Can you repeat that, please?
Peter, I was just talking about how damaging Fitch's move to downgrade the U.S. economy. How damaging is it going to be when investors are looking at the kind of confidence that they had in the past? Because the debt ceiling, like Anurag is pointing out, this is something that we saw happening over and over again. Now, Fitch has been among the first to point it out. Now, going into the future, is this going to show on the kind of confidence that investors have had in the U.S. economy?
I don't think so, because the economy remains pretty strong in the United States. And even if we move into a slight recession in 2024, we still are the largest economy in the world, and we still can produce anything, and not at 1 or 2 times, but sometimes even 5 times more than other nations can. So I think the move by Fitch was just a loud message to the politicians to be more fiscal, to have more fiscal responsibility, and of course to get their house in order. They can't keep spending forever and ever. It's not going to last forever. And I think that's what this downgrade was all about. Do I think
looking at what has happened
that
yes,
that we lose that the dollar loses its reserve status?
Yes.
No, I don't think so. That's very complicated.
That is complicated, you think. Anurag, do you agree? Global investors, of course, generally turn to U.S. Treasury securities whenever there is economic turmoil in the world. Is that phenomenon likely to change with the kind of downgrade that we are looking at?
No, not really, Vikram, because look, dollar will continue to be the reserve currency. And we live in a relative world. Ultimately, it's not about what US is doing in isolation. It is about if the other countries are doing even worse, then of course US comes out better. But but of course, in the corners, I think people are trying to figure out arrangements where, and especially with the geopolitics and the blocking of some reserves for Russia, I think people are trying to figure out, how alternatively they can manage being outside the dollar, because if it can happen to Russia, it can happen to anyone, right? So, so moving away from there, so it's not okay. It will stay the reserve currency, Vikram, but the limited point being that in isolation, even within US, I think the question is, almost every investor knows, and people are talking about it openly, that when will the government really talk about this elephant in the room? They spend 50 to 55% on entitlement programs, Vikram, which are largely about pensions, which is social security. It's funded a little differently than other countries, but that's where it is. And the healthcare spending on Medicare, Medicaid. And as the baby boomers rise in numbers and the people employed, then that number drops. I think it's going to be very unsustainable. So somebody has to do this tough talk, Vikram. And I think that's what the drop in governance standards that Moody's is talking about, that look, no party is willing to talk to people about some tough fiscal discipline, right? And if nobody is going to do it, then ultimately we know what's going to happen. Inflation will be persisting, and government will try to take it easy with inflating away the debt burden, which is not going to be good for anybody, Vikram. Certainly not for the markets.
The economic front, will the numbers have to do the talking? If Fitch is just going to talk tough and downgrade, Peter, as far as the possibility of a recession is concerned, that right now seems remote, because labor markets have been so resilient. We've been talking about no big dent on spending despite the Fed rate hikes. So the economy, like you pointed out, is doing well. As long as economic data supports the U.S. growth story, do you think any palpable change can be brought about in the way that Americans spend?
I don't think so, but I do think we're still headed for a recession. Obviously not here, not in 2023, but perhaps at the first or second quarter of 2024. I have never experienced where the Feds raise for almost a year consecutively, and the economy didn't end up in recession. This is a peculiar situation. And I think the reason for that is because of the pandemic. And so we're just playing catch up. But there will be a point in time when the rate hikes will impact the spending habits of the consumer. And that means less growth and possibly a mild recession.
To be able to tackle that, how do you think the Fed's going to move, Anurag? Very quickly, if I may come to you for that.
No, so I think, Vikram, and I think I concur with Peter, the battle for the Fed is a long one. Probably they know it. They are saying less, out in the open. But then, they know that as the government spends more, it is only making the job of Fed little harder. I think the battle is going to persist. And I think, to Peter's point, well, it has the only solution and cure for this is a recession. There's no getting away from that Vikram. At least I believe that.
Well, in a certain way, they were trying for an induced kind of recession. That hasn't quite happened. And whether or not it happens anytime soon, Peter's saying definitely not in 2023. We'll have to wait and watch that situation. But meanwhile, Fitch has called out